Hello students, welcome to the accounts class. This is the first of a two-part video in which you will learn how to prepare the trading and profit and loss account at the end of an accounting period. I hope you have your pen and paper ready. By the end of this class, you will be able to prepare closing journal entries to transfer account balances to the trading and profit and loss account. You will be able to account for inventory at the end of an accounting period. You will calculate the cost of goods available for sale, cost of sales, gross profit, and net profit. And you will prepare a trading and profit and loss account from a given trial balance using the horizontal format and the vertical format. You are familiar with the accounting cycle. You have used information from source documents to write up journals. You have taken information from journals and made double entry posts to accounts in ledgers. And periodically, you have balanced accounts and extracted a trial balance. Now, at the end of the accounting period, you will want to know how well the business performed, so you will be doing a trading and profit and loss account to determine whether the business made a profit or a loss. You will use information from the trial balance to do this. Firstly, you will do some closing journal entries to transfer amounts on the various nominal accounts to the trading and profit and loss account. Now you may ask, what are nominal accounts? Well, nominal accounts are temporary accounts in the general ledger that are closed off at the end of the accounting period. They are related to expenses and revenues. Now, accounts associated with buying and selling of goods are closed off by transferring their balances to the trading account. And accounts that are expenses or revenues are closed off by transferring their balances to the profit and loss account. Expenses include wages, rent paid, insurance, motor vehicle repairs, motor vehicle expenses, or loan interest. Income or revenue accounts include items such as rent revenue or rent received, commission received, and discount received. Balances on accounts that are assets or liabilities or owner's equity are carried down to the next accounting period. Now, let us look at an example. And the example says, for the year ended 31st March 2020, Alvin Scott had the following balances on his account and is about to prepare the trading and profit and loss account. Now you had opening inventory of 6,500. That was the inventory at the 1st of April 2019. Then there was closing inventory for $8,600. But note that closing inventory would not have been on the books as yet. On the last day of the accounting period, you would be going out to where you have your stock of goods that have not yet been sold, and you'll be doing a physical stock count. You will count the stock to determine what value the closing stock is. So that would not have been entered in your books as yet. So you're going to be doing a journal entry to bring the value of closing entry into your books. All right, now these are the other balances. Purchases, $63,800. Returns outwards, $3,000. Sales, $86,500. Returns inwards, $2,500. Wages, $16,400. Discounts allowed and discounts received. Now we're going to prepare the journal entries that will transfer these balances to either the trading account or the profit and loss account. Okay, so remember that if the item has to do with the buying and selling of goods, it will be transferred. The balance will be transferred to the trading account, while if the item has to do with expenses or revenue, that balance will be transferred to the profit and loss account. Now, here's what your journal entries will look like. Notice how the journal is ruled up, and you're familiar with journals. There's a column for your debit values and a column for your credit values. Now, the first one, let's take the first item on the list. It says inventory the 1st of April 2019, $6,500. Now, this would be a debit entry, a debit balance on the opening inventory account. So in order to transfer it to your trading account, you're going to enter a corresponding credit entry. You're going to enter a credit entry on that account because there's a debit balance on it. So to transfer it, to move it out of the account, you're going to place the entry on the opposite side. That would be a credit entry in the opening inventory account. So this is what your journal entry would look like. And remember now that when you make journal entries, you enter the account that is to be debited is entered first. So your trading account is going to be debited with $6,500, and your opening inventory account is credited with the same amount of $6,500. And the narration will say to transfer opening inventory to trading account. That was the first journal entry. Now let's look at the inventory at the 31st of March. This is your closing inventory. So remember that this had not yet been entered in your books, so now you're going to do that. You're going to debit the closing inventory account. Remember that inventory is an asset, so it's going to have a debit entry. Okay, to record it, you're going to debit the closing entry account, and the corresponding credit entry will be in your trading account. Okay, so the narration will state to bring the value of closing inventory into the books. Now let's look at the other items on the list. Purchases. To transfer the amount on the purchases account, purchases would have a debit balance. So to transfer that amount, you're going to have to put a credit entry in the purchases account. All right. So the journal entry will say debit trading account with 63,800 and credit purchases with the same amount. And the narration, transfer of purchases to the trading account. Next item, the returns inwards. There's a balance on it, and of course that is, it says returns outwards. There's a balance on it, and of course that would be a credit balance. So to transfer that credit balance, you're going to make a debit entry in the returns outwards account. So here's a journal entry. Debit the returns outwards account with the $3,000 and credit trading account. And the narration, transfer of returns outwards to trading account. Okay, and so we go down the list. All right, so sales and returns inwards are similar to those that we have done already. They are all being transferred to the trading account. All right, notice that sales will have a credit balance on it. So to transfer it, you're going to make a debit entry in the sales account and a credit entry in the trading account. To transfer the returns inwards would have had a debit balance on it. So to transfer that amount out of the returns inwards account, you will have to make a credit entry in the returns outwards account. So your journal entry will say debit the trading account with $2,500 and credit the returns inwards account with the $2,500. The narration will say transfer of returns inwards to the trading account. Now let us look at wages. Wages is an expense, and expenses have debit balances, remember? Right, debit balances. So if it's a debit balance on the wages account, in order for you to transfer it, you will have to enter a credit entry in the wages account. Now, wages being an expense will be transferred to the profit and loss account. So you're going to debit the profit and loss account with the $16,400, and you're going to credit wages account with $16,400 to transfer wages to the profit and loss account. Now, let us see how we deal with discount allowed. Discount allowed is also an expense, so it's treated similarly as we did with wages. The profit and loss account is debited with the $350, and discount allowed account is credited with the $350 to transfer the discount allowed to the profit and loss account. Now, finally, the discount received. This is a revenue. This is going to cause your income to increase. This is going to cause your profit to increase. So this time you're going to credit the profit and loss account. Okay? The discount received would have had a credit entry, a credit balance on it. So in order to transfer the amount from the discount received, you're going to debit the discount received account. Here it is, debit the discount received account and credit the profit and loss account with the $740. And the narration will say transfer of discount received to profit and loss account. Okay, so now let us look at the effect that these transfers would have on the different accounts. Okay, so let's look at the purchases account. Remember what the journal entry said we should do? Purchases. It said that we're going to debit the trading account and credit the purchases account. Remember that your purchases account would have had a debit balance on it. Okay, so in order for you to transfer what is on the purchases, you would have to make a credit entry. And that is what the journal entry told us to do. Credit the purchases account. Now, when you make that credit entry, it will cause both sides of the account to have the same total. That means the account is now balanced and there is no balance on it. No balance to be carried forward. Okay, it is balanced. Okay, now let us look at the corresponding entry in your trading account. So we have just entered a credit entry in the purchases account. The corresponding debit entry would be in your trading account. And here it is on the credit side of the trading account, $63,800. And so what we do here is that we're simply following the instruction that is in the journal. The journal told us which account to debit and which account to credit. Let's look at another account. This time, let's look at the wages account. Here it is. Remember we said wages is an expense, so it would have had a debit balance on it. But we are not going to transfer it to the trading account. We're going to transfer it to the profit and loss account, just like our journal entry had said. Let's find that journal entry. Here it is. Debit the profit and loss account with the $16,400 and credit wages with this $16,000. So here is the credit entry in the wages account, and let's find that corresponding debit entry in the profit and loss account. Here is the profit and loss account, and there is the entry where you are debiting the profit and loss account with the $16,400. So that completes the double entry. And you see that your wages account now is balanced. There is no balance on it. No balance being carried down. It is balanced. Okay? Now let us look at how we balanced the trading account. Okay, so before we balanced it, we had these entries on the debit side: the opening stock, the purchases, and the returns inwards. And on the credit side of the purchases account, we had the sales, the returns outwards, and the closing stock. Now to balance the account, remember, you add up both sides, and when we added it, the total on the credit side was greater. Total on the credit side was $98,100, and the total on the debit side was $72,800. So there was a difference of $25,300. Now you're going to put that difference on the side that had the smaller total, which was the debit side. So this is where that difference is going to be. But we're not going to call it a balance carried down. This is your gross profit. Okay, this difference between what you got from selling the goods and the cost of purchasing the goods, that difference is your gross profit. And so instead of saying gross profit carried down, we're going to say gross profit transferred to the profit and loss account, and that will complete the double entry. Okay, debit the trading account, credit the profit and loss account. So here is your profit and loss account with the credit entry in it. This is the gross profit that was transferred from the trading account. Now remember that your journal entry, when we followed the journal entry, we had these items transferred to the profit and loss account: the wages and the discount allowed on the debit side, and on the credit side we had the discount received. Again, by balancing the profit and loss account, we will see what our net profit is. The difference between the totals on both sides was $9,290. That is your net profit. Again, we're not going to say net profit carried down. Okay? This net profit is going to be transferred to the capital account. Because when the business makes a profit, or even if it makes a loss, it is the owner's equity that is affected. All right? If the business makes a loss, that is going to reduce its capital. If it makes a profit, a net profit, that is going to increase its capital. Okay? So this would be the debit entry in the profit and loss account. The corresponding credit entry would be in the capital account. Yes. And so we see that the double entry for all those transactions were completed. Now, when we do our trading and profit and loss account, this is not how we are going to present it, because there are certain items that we want to show in our trading and profit and loss account. This was just done to show you how the double entries were completed. Okay, now let's see how we want to show our trading and profit and loss account. Now this is the horizontal format of the trading and profit and loss account, where you have a debit side and a credit side. Okay, but you'll notice that we are making an adjustment to our sales by subtracting the returns inwards from it to arrive at net sales. Yes, net sales is one of those items that we want to show. We also want to show net purchases. Here it is. By deducting returns outwards from our purchases figure, we can see net purchases. We want to show net purchases because we don't want to include in our purchases those items that we had returned to the suppliers. We cannot include that in the cost of goods available for sale because we had returned it. We can't include it in the cost of the goods that we had sold because we had returned it, we never sold it. So we have to take it out. The next item we want to show is the cost of goods available for sale. We also want to show the cost of sales, the cost of goods sold. Okay, so when we present our trading and profit and loss like this, it's easy to see those important items. Notice that we're using two columns. Now the two columns will enable us to show and make adjustments to our purchases and our sales. Okay? It will enable us to show adjustments to our sales and purchases and other items. Okay, so we're showing all those items, and when you compare the two styles of presentation, okay, let us look back at the one we did before. You will notice that we're getting the same gross profit figure. However, the style that we showed, the example that we did before, the demonstration that we did before with the double entry, we were not able to see those important items. All right, let's move on. That's a trading account, that's a profit and loss account, and again we're seeing the same net profit. Okay, now that was the horizontal style of presentation. Now we can also show our trading and profit and loss account using a vertical style presentation where the items are listed, the accounts are listed on the left hand side and the values are shown on the right hand side in columns. All right, now you'll see that again we're ending up with the same gross profit and the same net profit, but this may be a little better to understand. All right, now how do we arrive at net profit? To arrive at net profit, you're going to subtract your cost of goods sold from your sales. So when you lay it out like this, it's easy for you to see what the cost of goods sold was and what the net sales was, so you can easily subtract one from the other to arrive at your gross profit or gross loss, depending on whether your sales, your net sales, is greater than your cost of sales. If your net sales is greater than your cost of sales, you will end up with a gross profit. However, if your cost of goods sold is greater than your net sales, then you're going to end up with a gross loss. Okay, so here it is. The items are easy to see. You take your returns inwards from sales to arrive at net sales. You subtract your returns outwards from purchases to arrive at net purchases. If you had carriage inwards, which is the cost of transporting goods into your business, you would have added it to your purchases figure. But in this case, there's no carriage inwards stated. There's no carriage inwards. Now, when you arrive at your net profit, you want to add it to your, when you arrive at your net purchases, you want to add it to your opening stock to arrive at the goods you have that are available for sale. And if you did not sell all of your stock and you have some closing stock left over, as in this case, you're going to subtract it from the goods you have available to arrive at your cost of goods sold. Okay, so there it is. Now, in your trading and profit and loss accounts is really two accounts, with the trading account done first, followed by the profit and loss account. Okay, so the top part is your trading account and the bottom part is your profit and loss account. So this is where your profit and loss account would start. It would start with your gross profit. You're going to add any income that was received during the period. In this case, there was discount received. All right? And then you're going to subtract the expenses to arrive at your net profit. Yes, so that is the vertical style of presentation. Now, the trading and profit and loss account is also called the income statement and is prepared to determine how well the business performed during the period. In your trading account, you will determine either a gross profit or a gross loss, while in your profit and loss account, you will determine either a net profit or a net loss. Okay, so we're just recapping now. Now your gross profit is calculated by subtracting the cost of sales from net sales. How do you arrive at the cost of sales or cost of goods sold? You add your opening stock to your net purchases to arrive at the goods available for sale, and then you subtract your closing stock. That gives you the cost of the goods that were sold. And to arrive at your net profit, you're going to subtract your expenses from the gross profit. Now, net profit is arrived at by adding carriage inwards, because carriage inwards is the cost of transporting the goods into your business. So it's part of the cost of purchasing the goods. And if you had returned any of those goods, you will have to subtract it to arrive at your net purchases. Now, the cost of goods available for sale consists of your opening stock plus your net purchases. Now, returns inwards is also called sales returns and should be deducted from sales because those goods were not sold. Returns outwards, also called purchases returns, should be deducted from purchases because those goods were not available for sale. Carriage inwards is added to purchases in the trading account because it is part of the cost of purchasing the goods. On the other hand, carriage outwards is charged as an expense in the profit and loss account. Carriage outwards is the cost of transporting goods from your business to the customer. So it is not going to be included in the trading account. It is a profit and loss item. It is an expense. Opening stock is added to purchases because it is included in the cost of goods that are available for sale. And closing inventory is deducted from the cost of goods available for sale because those goods were not sold. Okay, we will take a break here, and in the next video you will get some more practice in preparing trading and profit and loss accounts. I'll see you in the next video.